I guess you lose some and win some. As long as the outcome is income, I win it all and then some. Let's go. Welcome back to House Rich, the first time home buyer show. Yes, new name, but we still help millennials figure out where do I get started in real estate and how to build generational wealth. Today's topic is underwriting. Like, what in the world happens during the underwriting process? What's the underwriter looking at? Why does it take us so long? Why are they asking for all these docs? We're going to break it down. Today's intro was sponsored by Toronto-based philosopher Aubrey Graham. Let's get it. So think about this. A stranger comes up to you and asks you to borrow $300. Like, how much documentation would you need from that stranger in order for them to borrow some money from you, right? It'd be a lot or an infinite amount because you would not let a stranger borrow money, right? And so let's say you do go through the process of letting the stranger borrow money. You're gonna want to know a couple things. The main thing is like, hey, can you pay me back? That is the number one item. And so I find it slightly comical when folks are going through the home buying process and they're asking like two questions, like, hey, do I need a job and do I need money? Because they see all these bozos walking around online talking about, hey, buy homes with no money, yada 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 yada. And my response is always, would you let someone borrow money that had no plans or no way to pay you back, like they didn't have a job, or they quit their job and just started a new business and had no track record of revenue? Of course not. So why in the world would your lender let you do that? So that's what we're going to get into, is like the four things that your underwriter looks at during the qualification process. So if you listen to me, I always say your underwriter looks, or your lender looks at three things. Your underwriter actually looks at four things. So we're going to get into those topics. Let's go. Oh, by the way, so in that scenario I listed before, so the $300 scenario, now add 3 zeros and you're at $300,000, right? Now how much documentation would you need? So in order to understand what happens during the underwriting process, we need to jump back a little bit and understand what happens during the pre-qualification, pre-approval process, or whatever you want to call it. So your loan officer should be evaluating your credit. They'll typically run an automated underwriting system to make sure you meet the basic credit guidelines. If your lender has not pulled your credit and they've given you some sort of other letter, you're just hustling backwards, because there could be stuff in your credit report you don't even know about. I mean, credit is one of those no-go criteria. You either got the score or you don't. So if you're running around with a letter and your credit score hasn't been pulled, like I say, you're hustling backwards. I'll give you my scenario. You probably heard this before, but my credit score was 120 points lower than I thought it was. But luckily in my scenario, it was 120 points lower than the 800 due to a collection. But you can see another episode for that story. And so you want to know what your credit is. You also want to make sure your lender has seen your income documentation. Even if you're self-employed, 100% they need to see your income documentation, because remember, your CPA is probably doing your taxes, or you may be doing your own taxes. Their goal is to write off as much stuff as possible so that you don't pay taxes, right? However, your lender can only use your taxable income. So unless you're understand all the mortgage guidelines, you don't know what's taxable or usable income and what's not usable income. And honestly, most lenders don't know either. Unless you're like a Schedule C employee, you need to have an underwriter evaluate your income if you're like a S Corp and all those other complicated situations, because trust me, your lender is not qualified to evaluate your income. The vast majority of them are. Even I wasn't as a lender. That is something for an underwriter to do. And then lastly, and so if you have not submitted your income docs to your lender, your pre-qual is just BS. And honestly, how committed are you to the home buying process if you can't take 10 minutes to gather your income docs, right? And then the last part is your funds for the down payment. So you want to make sure that your lender is evaluating like what's actually on your bank statement. So I will say this, as a lender, I would tell folks like, hey, you can submit your bank statements or not, but one, if you're lying about your income, joke's on you, because you need income to proceed. And also, you want to make sure there's no what's called like large deposits, which are basically outside sources of income that you cannot verify. The actual definition is a deposit of anything over half of your validated like job income. So if you make $5,000 a month, you have a deposit that's $2,400 in there, the underwriter does not have to ask for documentation to prove what that is. But if it's $2,501, they have to ask what it is. And if you cannot source that income, they cannot use it. So that's important to know what happens during the pre-qual process. So hopefully you have a good lender and they've done all three of those things so you don't get jammed up during the underwriting process. So let's talk about what your underwriter looks at. So the answer is those three items plus the fourth, but with a lot more detail on the first three, right? So let's talk about income. I'll go through self-employed income first because I'm going to go through very high level, but essentially anything that was a tax write-off, the lender cannot use for income. So think about it this way. So the government makes these rules. So there's not going to be a scenario where the government's like, yeah, hey, this person can write off for $50,000 in income, but for the same process, we're going to have them be able to use the income when qualifying for the loan, right? And then just from a common sense standpoint, so when you're writing off stuff, you're saying that, hey, I'm writing this off because I need to spend this money in order to earn the income. So think about this. If you need to, so let's say you make $100,000 a year, right? But you spent $50,000 in marketing in order to generate that revenue. So your lender's looking at it and saying, hey, this person made 100K, but they have to spend 50K in order to generate the 100K, right? So there's no way that we can count the 50K towards their income, because if they took that 50K to put towards paying their mortgage, they wouldn't be able to generate that 100K. Hopefully that kind of makes sense from that standpoint, which is why you cannot use stuff that's considered a write-off during the home buying process. And so let's talk about being just a straight W-2 employee. That's a lot more easier to figure out there. So I forgot to add one thing for the self-employed income. You're going to need a 2-year history of that income, and your lender is going to wait and take a 2-year average. So example, let's say you made $80,000 after taxes one year, then you made $60,000 after taxes the next year. Since your income went down, your lender is going to use $60,000 as far as your income. But let's say you made $60,000 one year, then $80,000 the next. Your lender is going to average those two out to a $70,000 per year income. So it's always the worst case scenario when you're looking at the self-employed income, because you're your own company, and so it's a little more unstable from the lender's perspective, which is why they consider look at your income like that. All right, so if you're a W-2 employee, it's a little bit more straightforward. So let's say they're just looking at your base salary. So let's say you make $60,000 a year. You make $60,000 divided by 12, you make $5,000 a month is the income that the lender uses for the qualification process. That's it. So you need to have a 2-year history still, but it doesn't matter if you made that $60,000 a year for 5 years, for 5 months, or 5 days. So let's say you used to make $20,000 a year. You got a good promotion, congrats to you. Now you make $60,000 a year, and it's like the next day you make it, boom, you make $60,000 a year or $5,000 a month as far as the lender is concerned. And so once we get into anything out of like your standard base income, that's when you also need a 2-year history in order for the lender to include that. So we're talking about non-base income. We're talking about stuff like a car allowance. We're talking about commission. We're talking about overtime. We're talking about any special perk that is outside of your base salary. So you want to make sure that you have a 2-year history of that income, or don't even think about, or you can think about using it, but your lender is not going to consider that income, because once again, since it's non-base income, they want to make sure that there's a consistent, it's happening consistently. It's not just like there was one blip on the radar, like your company had lost a bunch of employees, and so they gave a whole bunch of people overtime for, the last 6-7 months. But if you're not going to be getting consistent overtime for the next, in the immediate future, the lender's like, hey, that's a one-time blip, so we're not going to consider that income in the qualification process. Thank you for listening to the show. If you want to connect with other listeners and also dive deeper into topics, as well as attend live trainings every Tuesday at 8 p.m., click the link. And so where I see people get jammed up in that process is, once again, they don't show the lender their income documents, or the lender does not know how to read the income documents. And they're just like, hey, I made $80,000 on my W-2. But in actuality, your base salary was $50,000. You made $30,000 commission, but you only made that commission for the last 8 months of that year and have no history on your current pay stub. And your lender does not use that extra $30,000. And now you qualify for a lot less than you thought you did, and your loan gets declined. So once again, always show your lender your income documents. All right, so what causes the underwriter to ask for more documents? So basically something isn't clear with your income. So once again, it could be a situation where your income has gone drastically down or drastically up, and they just want more clarification on why that happened. Maybe you overestimated your income and they want to make sure that they're not misinterpreting your pay stubs. and dock you income before they actually do. It's basically because something is not clear, which honestly means that you and your loan officer were not on the same page when you calculated your income to begin with. Let's talk funds for the down payment because it's not as straightforward as you may think it is. So what your lender is looking at is typically 2 months of bank statements because they want to make sure that they can account for all the money that's in your account for the last 60 days. They don't go back to the beginning of time, it's just the last 60 days of bank statements that they're looking at. So they're looking at two things. As I mentioned before, they're looking at what's called like large deposits, which are it's just any income over basically half your base salary. And they're also looking for just random deposits or reoccurring charges as well. Because sometimes there are items that aren't on your credit report that count towards your DTI that may be on your bank statement. So stuff like that is like private loans. Like they'll look at like rent deposits. So like if you're on a lease, like if you're making rent deposits like for your kid and you're on their lease to make payments, that actually goes towards your DTI. A lot of folks don't realize that. So if you have like a deposit to Lennox apartment in April, another deposit to Lennox apartment in April, in May, they're going to say, hey, what are these deposits for? And you're going to say, oh, it's for an apartment I'm paying for my kid or something like that. They're going to say, hey, I want to see the lease agreement. And if you're on that lease agreement, that goes towards your DTI, and that could kill your deal as well. So really the big two things you're looking for, and one is just to make sure obviously you have enough money in order to purchase the home. And so and one thing about that is as well, it's the whatever the highest amount is in the system. So as I mentioned previously on previous videos, a lot of times good lenders will estimate your lender fees higher than they actually are. But so let's say the system is saying, hey, you need $20,000 to close on the home because they've estimated your lender fees high. If you don't have $20,000, you can't pass the underwriting stage. So two things have to happen. You have to get over $20,000, or your lender has to get the actual fees from the title company, which may come in let's say they come in at like $18,500. So until the system is updated with those lender fees, you cannot pass the underwriting process. But once again, they're looking at large deposits, and they're looking at make sure you have enough money, and they're looking at random deposits to make sure that you don't owe anybody money that's not accounted for on the credit report. Oh, and let's say you're getting like a gift letter from somebody, they're going to verify like the relationship between that person that you're getting the gift for to make sure it meets the requirements for that specific loan program you are using. And so they ask for more documentation if they have questions about any of those aspects of your bank statements. So credit is a little bit more straightforward because like I said, you either have the score or not. So a lot of times folks will get denied during the automated underwriting process because you just have below the standard credit score. But also you can have slightly above the required credit score and still get declined during that automated underwriting process as well due to other aspects of your credit profile. So that's why I say, hey, like conventional minimum score is 620, but a lot of times you want to have north of a 640 because if you have a 620, there are certain negative things on your credit score that will keep you at that 620 level. And so your underwriter is also examining your credit report just to make sure that you are the person you say you are. There's no mismatches on your social, that there aren't any like bankruptcies or foreclosures. And so that's your credit profile, but also they also run another report as well on top of your credit report where they find stuff like bankruptcies, foreclosures that you may have had, cleaned. I'm doing air quotes if you're listening to the podcast. You may have had cleaned by some credit repair person, but they're looking at stuff that's in public record too to make sure that there's nothing that you're trying to hide. So I always give this example. You think you're going to pay somebody $150 a month to erase like a bankruptcy, and a multi-billion-dollar corporation is not going to find it? No, they're looking at public record and all that other stuff that people claim that they can get rid of in credit repair. It's not. There's a difference between what's on your credit report and what's in public record. Once again, your credit repair person is not Ethan Hunt. They're not crawling through the system, flying down and hacking into some mainframe to go into the local court system and erase the stuff from the database. That is not happening. It's still there for public record. So that's what your lender is looking at as well. So there are certain things that are just showstoppers, like bankruptcies within a certain time frame, foreclosures. There's certain like child support. Like if you have child support somewhere indicated on your credit report or public record, they want to see the documentation for that as well. So all the things that credit repair people claim that they can get erased from your credit report, sure, but it's not erased from public record. So they'll ask for more documentation if they have any questions about anything that may have popped up on public record that is not actually on your credit report. And so the last item is the collateral. And so obviously there's no way that your loan officer can evaluate the collateral before you even make an offer on the home, right? And so what the underwriter is looking at is just you're going to get an appraisal done on the property. And so an appraisal is not an inspection, but there are certain things on the appraisal that can be a showstopper for the loan. So like stuff like safety issues, like roof issues, foundation issues, are like showstoppers for the qualification process. So those are things that like the appraiser will say, hey, this appraisal is incomplete. And sometimes even if the appraiser says this appraisal is incomplete, there may be certain things in the picture that, and so it's not the direct underwriter, but it's like an evaluations underwriter or an appraisal underwriter will look at and say, hey, the appraiser saying it's all good, but we see like water stains in the basement. We want more information on that. Or we see like a puddle in the basement or something like that. Or we see like the appraiser says these cracks are okay, but we don't think these cracks are okay. We want you to get more information on that. And so your appraiser is just a generalist. And so what happens is your lender will say, hey, we want you to get like a structural engineer out there to give the thumbs up or thumbs down, or a plumber or somebody out there, somebody that's a subject matter expert, in order to give the thumbs up that this is not a big deal, or to tell you that, hey, you need to get this fixed. And so it's not, hey, you can get this fixed later. You need to get it fixed before the funding happens. And so that's what your underwriter is evaluating, as well as that part of the process is the collateral, and then obviously making sure that the home appraises for the value that is on the contract, because your lender can only lend you the lower of the sales contract or the appraised value. So it's not like if the contract is for $300,000 and it appraised for $350,000, they'll lend you $350,000 and you get to keep the change. That's not a thing. It's just it's the lower of the two. And so also part of that collateral is making sure that the title is clean, making sure that there are no liens or encumbrances on the property. And so that's done by the title company. So that's a lot of times why the underwriting process takes so long, because the lender can, or the underwriter can look at the first three, credit, income, and funds for the down payment, be like boom, boom, boom. But they have no control over how quick the appraisal happens or how quick the title company does their title work. And so that number four, this last part, the collateral, is usually the longest part in the evaluation process. And so that's why the underwriting process may take sometimes 2-3 weeks to get through, even though your lender may be saying, hey, everything's all good. It is all good, but we just need to wait for the appraisal and the title work. So there you go. That's what happens during the underwriting process. If you enjoyed the podcast, leave a review. That really helps us a lot, like the podcast. But more importantly, like, leave a review. So you've listened this far. It takes like 20 seconds for you to click on the episode, click down to the bottom, and leave a review. I would appreciate it a lot. And as always, buy land. Rumor has it they're not making any more of it. See you next week.